Welcome, everyone. Welcome to this special session on the budget. Of course, everybody's wondering what's going to happen. Budget is there, so much volatility going into the markets. And then the market has also not been very kindly the past few months. So for all these questions that you may have in your mind, we have, of course, Mr. Taher Badshah with us from Invesco Mutual Fund. And we are hoping for a lot of answers from sir. So let me get right to the meat of it. First off, markets have been bleeding for a while now. What has been happening, and what's your outlook from here on?
Uh, the current weakness of the market actually, the genesis of it actually lies in approximately a quarter back or 2 quarters ago, approximately, I would say about towards the second half of last year, that we actually started to see the economy normalizing more towards its pre-pandemic trend levels, which were more in the vicinity of around 10 odd percent nominal GDP growth and corporate earnings equivalent corporate earnings being in the vicinity of somewhere between 12 to 15% versus the 20 odd plus percent that we had seen in the prior 2.5 years post COVID. So that was at one level on supposed to be on expected lines. I mean, it was bound to happen at some point of time, and the other way would have probably started to normalize growth. But this was not at some level also not fully captured in the expectations, earnings expectations as far as the market is concerned. And as that started to manifest, and we first saw the impact of that in the results for the September quarter, which came around the October-November period. Since then, we have basically been on a somewhat weaker drift of the market, so to speak, from then onwards up until now over the last 3 odd months. I think that is how it started off, alongside which obviously it has been compounded by some of the other developments as well. From a domestic standpoint, while this normalization is not necessarily something which one should have not fully expected, but the thing is that some parts of the structural story of India have once again started to get questioned, especially with regard to the investment cycle. The after COVID, India's economic output was being guided by the investment cycle more than the consumption cycle. And India has always, of course, been very well known for its consumption economy, its large consumption base, and relatively underpenetrated product lines, etc., and a very vast market, local market, domestic market. But it has not necessarily been as well known for a good investment cycle and an investment as an investment economy. And I think that was a promise which was beginning to come about post-pandemic, when the government took a very strong stance on invigorating the investment cycle in the country, largely through very large allocations, strong allocations to public expenditure in the budget post 2021-22. So that meant probably started to herald a new type of growth pattern as far as India was concerned, and that was very welcome as well, because India has not had a good investment cycle for a very long period of time. And it was very important, especially from the point of view of job creation and spurring manufacturing, etc., etc. But towards the second half of last year, this cycle started to kind of once again sputter a little bit. In fiscal 25, April till date, April to November, the actual public expenditure of the government is down 13% year on year. It was expected to be about 10% higher during that same period of time and for the full year as a whole. But it has, unexpectedly weakened in that period. It's been difficult to kind of, understand as to why this is happening. Reasons are not very clear. It does get attributed to elections and the uncertainty around and after the elections. But we've not really had a very strong, reasons forthcoming for the slowdown which has happened in the course of the last 6 odd months. And I think that has basically, from a narrative standpoint, affected India's investment narrative for domestic as well as foreign investors at large. And that is basically, I think, one of the more deeper reasons which is leading to some of the cracks that we are seeing in the market today. Alongside, as we've traveled through time, post November, post the US elections, some of the other uncertainties, especially given the you know very new mercantile world which the US administration is now envisaging, is something which the world will have to grapple with. It is something which is quite unexpected, and many of us do not really have a clue as to what that unfolds for us and what all that means for us as well. So I think those complexities, those uncertainties have also come in the way of the market sentiment overall. I would like to therefore think that, look, I mean, we were normalizing. In any case, growth was probably slowing off. And alongside which, this compounding of the situation from a global standpoint is likely to persist for some part of this year. We've had very strong, good, strong 2 years, 2.5 years of economic growth as well as market appreciation. We are sitting on very strong returns of the last 2.5 years. I think it is important for investors to probably calibrate expectations downwards for calendar year 25, as it looks like. When we started off, for example, in 2024, I've been on record saying that we probably have returns are probably going to be a lot more front-ended, with the first half of 2024 being a lot more stronger than the second half. When I look into 2025, from where we are sitting right now, to me, it looks like it's going to be the exact converse of what 24 has been. So we will probably start off on a much weaker note. We will have a first half which is going to be relatively weaker from an economic as well as a market standpoint, and then hopefully we start to see some acceleration in the markets and a little more back-ended returns in the course of 2025. So this is the starting point of what the outlook looks to me as things stand today.
That's absolutely brilliantly put, I think. While we discuss a number of factors for the current market scenario, how do you see budget fitting into the picture along with this? How would the market react, and what do you think about this?
So the importance of the budget, according to me, has probably gone up in the context of what has happened to the economy as well as in the global markets, and even in the equity markets over the course of the last 6 odd months. And to that extent, I would also want to say that once again, 2025 is going to be a year where the direction and the strength of the market will probably be significantly more policy determined. Policy will have an important role to play, and I'm here talking about both monetary as well as fiscal policy. So in a way, if I were to probably argue that the government and the RBI will have an important role to play in terms of determining the course of the economy, as well as then the eventual recovery that we probably expect as we sit today towards, let's say, the latter part of 2025. And therefore, to that extent, the budget, which is a tool which is going to be an important element of the whole fiscal mix and the fiscal policy, is also assumes a fair bit of relevance as such. Usually, in the last some years, while the budget generally is looked forward to, I think over a period of time, as we know, the importance of the budget has somewhat waned because some of the finer aspects of taxation, etc., direct, indirect, etc., and a few other things have actually gone off the budget and into other forums. But I think this budget will be relevant from a few points. One is that in the last 2-3 years we pursued the path of significant fiscal consolidation. I think the government still intends to continue on that path. However, I would like to submit that there may be a need to probably be a little more, less harsh in terms of fiscal deficit, given the context of or the backdrop of a slowing economic environment. I think the government will have to pay adequate attention to also making sure that while we, of course, do stick to a certain conservatism as far as fiscal consolidation is concerned, but we shouldn't really lose sight of growth as well. I think that growth narrative for India is very important, both from the point of view of not just keeping the markets happy, but in also ensuring that overall economic growth continues, job creation, and all the other parts of the economic mix are satisfied. I think from that standpoint, it will be important to see as to how the government proceeds on those lines. The second thing is the reacceleration of the capex cycle. Like as I said, we've seen a moderation in the capex cycle in the course of FY25. The first half of 25 has been lower by 12-13%. We need to have some urgent focus measures once again back to ensure that the investment expenditure of the government is strengthened. We cannot, while we of course need private capex also to kind of follow through, but we cannot wish away the fact that more than two-thirds of the economic spend is undertaken by the public sector in India. So they are an important element of the mix, and therefore we need to have that um, reinstated, even if it probably happens to be at the cost of the fiscal to some degree, as such. So capex revival therefore becomes the most important paramount thing in my view, and whatever signals are available, I think will provide a fair bit of confidence to the markets in general. I think then the second part of the problem that we have been facing, even in the recovery period post-COVID, as we all know, is that we've been, as far as the consumption leg of the economy is concerned, we've been basically having a K-shaped recovery where the upper and the top end of the income pyramid has actually been doing very well from a consumption standpoint, and the lower end of the same pyramid has actually been flagging off to a fair degree over the last 2.5 years. I think therefore we need some very strong policies which basically are directed towards increasing household incomes. Not necessarily with the, I mean, the starting point should not necessarily be increasing consumption, but to basically, but important thing is to address household income. So if you address incomes, then automatically consumption at some level gets addressed. So we need to kind of prioritize incomes over consumption at one level, and therefore, even some of the existing policies of the government, whether it is Manrega, PMK, and PMAY, all these things need to kind of be further strengthened, and probably some other methods and tools will also be required in order to spur household incomes. I think what can also go a long way in doing that is at the other end, simplify the tax structure. I think that's something which is probably, to my mind, going to be very important, especially from the point of view of rationalizing GST. I think the tax burden, the overall tax incidence of the consumer, as we all know, across the income strata. I'm not necessarily talking about only the low or the mid or the upper end, but by and large, the entire spectrum is reasonably well burdened as far as taxation is concerned. I think we need to kind of rationalize the tax burden. Maybe even look at setting the rules for GST, simplifying the GST structure. I understand that this is not necessarily going to be an activity which is going to be part of the budget, but if there are certain guidelines or at least certain indications which come out which try to address this matter, I think that will also be welcome. It will it will go a long way in restoring the confidence on India's consumption growth for the future. I think maybe I would think that from a budget standpoint, even certain ways and means to actually spur private sector capex may be welcome. So some sort of tax incentives in order to rejuvenate, boost private capex also would be welcome, especially things like maybe a depreciation policy or an investment allowance policy or a taxation policy would kind of go a long way in helping that objective. Housing sector is one very vital part of the overall economy as well, and all the measures which can be undertaken in order to boost the housing market in India and the housing sector would be. It's a very large employer. Indirectly, construction, housing, all that will be a very large employer, is a very large employer of the economy, and measures in that direction would once again be something which will which would be necessary at this stage of our economic cycle, where we are going through this patch of slowdown. We don't really want the slowdown to aggravate. As of now, I think the market is still probably on the view that this cycle, this down cycle, is going to be relatively shallow. But obviously, we can't take things on face value, and especially at this stage of the global as well as domestic economic cycle. So, it requires these are things which will require urgent attention, and I think the budget, in to that extent, therefore, can play an important role. And then there can always be a few things around, capital gains taxation or dividend taxation, debt instrument taxation, or debt mutual funds. These are some of the things which are still not fully aligned and probably needed redressal. So I think this is probably the area. So, like as I said, I mean, this budget to that extent, therefore, assumes a little more importance than, to my mind, some of the budgets of the recent past.
Right. Well, you did touch upon a few sectors. Could I ask you to list down a few sectors that you have your eyes set on for this budget? Which sectors do you see the budget supporting?
So usually we, uh, do not necessarily try and uh, preempt as to what kind of sectors will probably be supported, not supported in the budget. But I mean, I'm just thinking of it more from a top-down perspective. As I said, that today both the things are equally important. Like as I said, 2 or 3 years ago, the investment cycle and the support to the investment cycle was a must. Consumption, we thought, would naturally come back after COVID. It didn't necessarily come back in the way it was anticipated, but that was a natural expectation. Uh, Now, I think with the nature of the consumption being more K-shaped, what we have seen in the last 2 years, and the fact that the investment cycle is also going through a softness, I think at this stage both are important. And when these two become important, then it can have an impact on a diverse set of sectors, because investment at one level has many underlying sectors, whether it be manufacturing, whether it be industrial, whether it be light engineering, whether it be construction, or whether it be ports, logistics, railways, defense. All of these are actually subcomponents of the investment cycle and the investment economy. So if we get a boost to public capex once again, then some of these sectors, all of these subsegments of the economy, then start to benefit. And similarly, it goes for consumption as well. That if you were to probably start, try and boost consumption, especially at the lower end of the income pyramid, then I think value retail, value consumption, these are the pockets which to my mind probably become interesting going forward. It could be some parts of the auto space. It could be some parts of the consumption space. It could be some part of the discretionary consumption space as well, which is perhaps languished in the last some time. And I'm talking about, let's say, things like low ticket items, QSR, while the big ticket items and the premium segments of the consumption space have done very well, but the mid and the lower end, retail portions, QSR, a few, let's say, the white goods segment. These are things which are probably not kept pace post COVID with the general recovery of the economy, and that those are the things that I would probably expect to be benefited if the government policies move as per my understanding.
Absolutely. Budget season is also seen is marked with a lot of increased volatility. And given the recent times when we have seen Nifty moving up 200 to 500 points randomly every other day, this becomes an even more important issue, pertinent issue when we are discussing budget. So this year we'll have budget on a Saturday, and amidst a lot of volatility, and budget in itself brings a lot of volatility. So my question to you is, how does an investor look at it, and how does investor navigate any risks associated with this volatility?
Look, at one level, I don't really think investors need to, uh, either invest or trade in and around the budget, and it doesn't necessarily beyond a particular point add any value. I mean, that the whole, what I mean is that the whole process of trying to make investment decisions which are based on the budget alone, and during, in, or around the time of the budget, before or a few days before, a few days after, actually, to my mind, or even a few weeks before and a few weeks after. To my mind, I think beyond a particular point is a fruitless and unnecessary exercise. I think more particularly the pre-budget. To my mind, we generally not paid as much of attention. If at all, what probably helps to helps at any level is a post-budget analysis, because at least by which time you know what the facts of the matter are, and you have a relatively better understanding, perhaps, of where the mindset of the government lies from the point of view of the next 12 months, and how do they want to steer the economy, instead of engaging in mindless speculation about things which may or may not materialize before the budget. So I think the best thing to do is, to my mind, I think probably reduce participation levels, especially from a trading mentality or a trading standpoint. Uh, 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 and this budget and the market's volatility today is not necessarily a function of the budget alone. As I explained, several factors are at play. Some part of the volatility and the downward bias of the market has already been in play for now 3 4 months. Maybe it was somewhat less visible over the last some time. It has now become a little more prominent, and it's coming in the eyes of the general investor. But there has been that palpable weakness which has been there in the market for some time, thanks to a host of things which I described earlier. And budget and now the global developments probably compound the volatility. So I would not necessarily, to my mind, advise investors to try and preempt or trade in and around, or even try to make investment decisions which are just uh, guided by the outcomes of the budget. Budget at some point in time starts to lose relevance after a few weeks after it comes through. So it has a relatively shorter shelf life, as we all know. But even if we were to probably engage ourselves into the mechanics of the budget and what it is all about, it is best to do it post facto rather than try and preempt it.
Absolutely. Okay, so volatility aside, what are some other key risks that do you think investors should be aware of around such volatile seasons or budget seasons or high profile activities in the market?
So the risks are always more. I mean, around these, any event risk is basically, you know, more short term in nature. Uh, it doesn't typically have very long term consequences. And especially a budget document, which is basically more of positioning for the foreseeable next 12 months. Uh, Unlike, let's say, some of the policy decisions which perhaps the new incoming administration in the US is embarking upon or likely to embark upon, those are probably things, policies which are probably more far-reaching in nature and not necessarily only restricted to the domestic economy in the US and has ramifications around the world. Those are things which require a lot more attention, and maybe perhaps one can try and understand that in a little more detail. But I think budget does not necessarily, to my mind, I think the risks are now somewhat muted. It is more of the known risks that if the government does not necessarily, for example, give a boost to capex, or probably does not take measures to revive capex, and that's something which the market is already starting to absorb and reflect in the volatility and the downturn over the last some weeks. So I don't really think that is an incremental risk. It may still, on the day of the budget, there might be a negative, reaction. But I don't really think that becomes a negative, I mean, a new risk, so to speak. But some of the things which are required from a longer term perspective, like, for example, to normalize the K-shaped consumption, how do you bring back the rural economy into play? How do you bring back, household incomes to stabilize? Um, uh, um, these are some of the things, the simplification of, like, for example, I said the taxation structure in India. Those are relatively more longer term, factors, and they require more greater importance and attention. And if we can get some cues around that, and nothing happens around those, then probably they portend of some more risks in my view, or heightened risk in my view, than otherwise. I think even things like a revival of the MSMEs, which is again something which has been on a bit of a structural decline, especially post-COVID. Um, uh, we've all known about the consolidation wave across many industries where the unorganized is turning into more, the unorganized market share is moving more towards the organized market share. In that process, while some of the larger corporates in India and the listed entities and the more organized entities have benefited, but it has had some very negative consequences to the MSME portion of the economy, which is once again a very large employer, self-employer. It does employ other people as well, and more importantly, it is a breeding ground for training for people to acquire certain basic skills, which over a period of time can be ported to the organized sector. So I think measures which actually are aimed towards reviving MSMEs in India, which has actually been seeing some decline over the last a couple of years post-COVID. Those are that is something which is more relevant, more important. So the risks are more if some of those longer-term measures are not indicated or put into place or addressed by the budget. I that is what is probably what I would think of as risks which are associated with the budget.
Absolutely. All right. My next question is looking beyond the immediate budget and the current event. What are some of the key themes or trends that you see coming up in the Indian market, and how can investors best position themselves to benefit from them?
So I think while I did outline a scenario where some of the near-term issues are a little more complicated, and we have to kind of address those as well. And obviously, some of these, if not addressed, can become longer-term issues as well. But for the moment, I would like to think that they are more here and now, more near-term, and probably have more shorter-term implications. If well addressed, then we probably will be back in the reckoning, and we will once again continue on our growth cycle, maybe somewhat stronger growth cycle as well over a 2, 3 year, 4 year time frame compared to what we envisage will happen over the next 12 months. So I think from a more longer term standpoint, medium to long term standpoint, we still feel quite confident that we are in a good place as far as the economic cycle is concerned. We see some of the uh, uh, important themes which have been around for some time, continuing to assert themselves, whether it is manufacturing, outsourcing, whether it is things like certain areas where we benefit from a global standpoint in terms of being able to gain market share, whether be it in terms of the whole change in the energy profile of India as we transition from being a purely fossil fuel based economy to a more mature economy with a diversified fuel mix, a diversified energy mix, and some of the associated opportunities which perhaps, like, let's say, for example, in the power sector, or more particularly in places like transmission and distribution, I think are going to be very important. I think themes like defense and railways, more from the point of view of ensuring better levels of logistics and connectivity, is something which is going to be is also something which is a recurring theme, and I think it has got is reasonably more durable. So some of these things, India has a long way to go, and we've these things have become important in the recent past. I think we need to make sure that they don't um, get into oblivion. They are supported well, nurtured, and we're able to take the maximum advantage of that. So in a way, there are a fair bit of themes which have been around for the last some time, and we look forward to the continuity of the same. Uh, Alongside which, can there be certain new themes which can emerge, perhaps, let's say, in the areas of healthcare, maybe even in probably things like advanced materials meant for meant for a world with a different energy configuration. I think artificial intelligence, indirect, benefits out of AI is something which we will probably be looking forward to, or could turn in the form of opportunities, with certain corporates being indirect beneficiaries of the same. We may not necessarily have an equivalent of a Google and a Meta, for instance, but I think we may have companies which might indirectly benefit out of that opportunity. So there are multiples of these themes which are prevalent. Some will continue to strengthen. I think there will be some companies which will be going global in their efforts, and they've developed and cultivated a very strong footprint domestically. Maybe there is a time for a few of these franchises to assert themselves globally. In the process, perhaps even creating some global brands out of India, more likely in the services sector than in the manufacturing space. But that's another theme which may have relevance, and probably any investment opportunities around some of these themes could deliver some very good results over the coming 3 to 5 years.
Absolutely. That sounds very insightful. Okay, my final question to you before we conclude is one, if you had to leave one parting advice or one concluding advice for all our viewers out there who may be new to markets, who may be old to the markets, what would it be?
I think it is a very simple thing. We just basically have to kind of not forget the importance of compounding, and I think an annual return of 25-30% in a couple of years, and then a flatter return in is and deviates the attention from the fact that if you have more consistent compounding and over a period of time, even if you were to make 15%, much lower return compared to what we have seen in the past few years, but the compound effect of a 15% held for a reasonably long period of time is far bigger than the benefit that you derive out of a short term 25-30%, or maybe even a 50% appreciation, especially if it is followed by a dull few years. So I think one basically has to take a longer term view of things. That remains the cornerstone. Staying invested around all these throughout the journey is something which is equally important. I think use the opportunities in the market, and especially declines are supposed to be not feared. They are to be welcomed. Uh, because those are the times when you actually get good deals in the market, and they do give you that ability to enhance your overall return profile. So in parting, I would, while I may have appeared a little more conservative and um, somewhat downbeat as far as my prognosis for the near term in 2025 is concerned. From a market and an economic standpoint, yes, but from an investor standpoint, I would also like to think that as we are in this midst of a somewhat corrective phase of the markets, and we're going through a bit of time as well as absolute correction, for investors, it will turn out to be an important period when you get those investment opportunities and ability to get into the markets. Back-ended returns, yes, but investments need to be front-ended. So the first 6 months of the year, calendar year, or maybe even the fiscal of 26 is going to be the period where you actually get your investment opportunities for your subsequent returns to come through, maybe in the following 18 or 24 odd months as you get into calendar year 26 and 27. So do watch the markets for that. Do keep a tab on what's happening from that standpoint. Use those dull days of the market, such as today and maybe of the last some time, and perhaps you might have a few more of those in the coming few months. Use those to your advantage to build, if not long term, at least medium term investment positions for yourself, and that will allow you to maximize your returns.
Absolutely. Thank you so much for those insights. And I hope you'll allow us to learn more from your experience in future as well.
Certainly. Thanks for having me on your show, and hope to be of we can probably engage in the future as well, as and when.
Absolutely, I'd be glad to. Thank you so much again.
Thank you very much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.